So let's begin where we usually do at the S&P 500 on the daily. If anybody out there is telling you that this market is bearish, then I think they're really just not looking at the charts. They're not paying attention, or they're really just kind of focused on all of the negativity that's coming at us from the barrage of news flow currently. And certainly a lot of it is negative. But understand, remember, that the market does not really ever care about that sort of thing. The market is a very, very forward-looking mechanism, and B, the market is also extremely influenced by the actions of the Federal Reserve. And throughout this entire crisis, the Federal Reserve has made it very, very clear that they have a lot of bullets left in their gun, and they're going to use them. So I think that that is the real driver of what's going on in the market. That's the underpinning, if you will. It's like the Fed put, it's the protection that's there in the market through their activities. So that being said, let's just take a quick tour through the technical picture here in the S&P. I've purposely put these two trend channels up. Here's our main trend line from the lows, and we just kind of swing out and we touch the first low that we can touch. And here we're just connecting these lows right here, and it's left us with a channel. And you can see here that we're really just in the middle of the channel. You can't, it's obvious it's a very clear uptrend. The market definitely has more room to run. We could certainly go to the top of the channel. One of the things that, as you know, I pay very, very close attention to is when we came to this 200 period moving average right here, if you recall, we were also just above the 61.8 retracement, which was here, correct? We kind of took a little bit of time to resolve that. That was the 61.8% move from the high to the low. And since then we resolved that, and we've made this little kind of balance area right here just above. And one of the reasons that I think the market is balancing here, and I know a lot of you may think that it has a lot to do with the news, and don't get me wrong, even though I really like to keep things very technical and downplay what's going on in the news, I do understand that a lot of the back and forth is caused by that, right? We've seen a lot of liquidation breaks and then being kind of bought back up, et cetera, et cetera. And remember, when you're thinking about these liquidation breaks, and we'll get a little bit deeper into it when we move over to the market profile shortly, just remember that they strengthen the market by taking potential sellers out. That's really the thing to think about. One of the easier ways also to think about it is that you get a lot of knee-jerk sellers that really just do things at the wrong time, that are very quick on the trigger and news-driven, and they're not paying attention to context, which is something that we teach endlessly here in ShadowTrader. Really, our MO is literally just teaching people context, how to fish, not to just give them fish. But if you really truly understand context, then all market moves are within that context. And if you can understand things within context, then price really takes on a whole different meaning. Price by itself, as we always like to say, is very, very misleading. Remember that price is nothing but an advertising mechanism. It really is. And by itself, that advertising mechanism really just wants you to engage with it, but it's really not giving you a lot of information as to what the next progression is going to be from where it is at that moment. Really, only contextual clues can tell you that. So, regardless of that, S&P continually intact with the channel. I'm going to move over to, and one of the things before I flip over to the next index, I just want to point out, we talked about this in a prior video about keeping things very simple in terms of where is everything in relation to simple moving averages, etc. So notice that the 50, which is the first time in a while, has finally started to turn up. I think that's kind of interesting. We've had a rising 20 for a while, and as I've already talked about, we are now resolving the 200. And this is typical because 200s generally take sometimes multiple days to resolve. Look at what happened here, correct? When you went through the 200, you went back and forth on it a couple of times. This is very, very typical. So it's really no big surprise to me, even though, yes, it does seem like it's being driven by these headlines lately, that the market is taking a little bit of time to resolve the 200, okay? Next, we're going to move over to NDX. NDX is very, very interesting to me because it has a very, very concrete target coming up. This is a great place around the 97.40 level to be looking at butterflies, unbalanced butterflies, ratio spreads, etc. Hint, hint, these are the types of things that I teach every single day via live trades in text message in my weekly options advisory. We specialize in very esoteric ways of looking at the market where I try my best to construct spreads that don't really cost a lot. I'm a big believer in risk reversals where if without just laying out big debit for call verticals, I sell put verticals to finance them. All right, I'm a big believer in broken wing butterfly or unbalanced butterfly or ratio spreads 1/2 or 1/3, where we can leverage the power of the options we sell to bring those debits down to near zero or even sometimes tiny credits, and thereby trades that would be losers because they don't go in the direction that you expect actually end up being break evens or small winners. And that really makes a big difference over time. So just one of the best sort of setups to look at in terms of applying those types of spreads is almost always when you have a market or an instrument that's moving up right to a very prominent resistance point where you believe that it is going, but it is not going to be able to go through right away, right? So that makes perfect sense. That's actually the type of place where you would want to have, like I said, any of those spreads that I mentioned where you're leveraging those short options and you can just come up right against the shorts and those long options underneath that are going to have some value. So NDX is in a really nice position, I think, for next week. I'm actually very excited about the way the NDX has been acting. Notice that this very bearish candle here had a little bit of a spike. Notice, this is very, very interesting to me. Notice that all of the pullbacks here have actually, you know, they're messy. They got big chop and, you know, kind of this is bearish bar and then down here up, close, strong. They're messy, but at the same time, it's orderly because notice how the channel is holding so perfect. We established this channel a while ago after the breakout from this very large area. And notice how the channel, all the lows are to the low end of the channel. And not only that, the 20 has come up and supported every time. This tells me that short-term buyers are in control, maybe even longer-term money, but regardless, buyers are certainly in control. They are not able to find stronger sellers as they come down to these supports. Sellers kind of disappear and they're holding. And the other thing that kind of excites me for next week about the high odds of moving to the prior high is just the simple fact that you really have a lot of touches here in the same area. Notice that you've got resistance of these two candles. This one, and this one. Notice how equal all of the highs are. It's very, very interesting. When you have that many equal highs, what do you think the market's going to do next? It's probably going to knock on that door one last time and go. So next week is really going to be all about that touch in the NDX, and that's why towards the end of this video I'm really going to spend a lot of time on FANG, which are the stocks really that I trade more than anything for day trades and weekly options trades and whatnot. They're the stocks that I feel most comfortable with. A lot of them are also setting up for slightly higher moves. All right, last but not least is the Russell. Russell has been dragging a bit, obviously, in the bigger picture. Lately, over this period, there's been actually relative strength in the Russell, which, you know, look at how much it's shot up here, kind of parabolic with a lot of big green candles. That's actually a good sign because we were waiting for the Russell to get up to that 61.8 retracement, and it did. I think that the reason the small caps are selling off now is really just a resolvement of that 61.8, but I think it looks great. You know, there's maybe potential we get all the way down to the trend line, but I really doubt it. I think with the NDX kind of back in the leadership position, shooting for that all-time high, I don't really see the rut coming down too much, but I do think it is also, or I should say also, I do think it's kind of bullish that it's finally getting up to its 61.8. Even though it lagged getting there, it took a much longer time to get there than other indices, and now it needs to just resolve that level. Okay, let's move into the market profile section of the presentation. Nuances, as I always call them, because that's really what they are. They're all the little nuances, I guess, for lack of a better word. That's really what they are in terms of market profile, what you want to be looking at: poor highs, poor lows, spikes, single prints, all of the things really that traditional charting is never going to show you. You're only going to be able to see these types of things clearly using a market profile chart, and that's simply because the market profile chart does something that the regular, more two-dimensional candlestick chart does not do, and that is that it does not bring in the element of time. One candlestick bar going from low to high, looking like this, right? We know that that one bar encompasses an entire minute, an entire 5 minutes, an entire 15 minutes, half hour, hour, day, week, month, whatever, but everything is in that one bar. But we don't know inside of that bar how much time was spent at each specific price that made up the range of that bar. And that's what market profile does, essentially. In its most simplest definition, market profile is basically showing us how much time was spent at every single price level. And that's basically what these capital letters here mean in all of the distributions. I, of course, use the ES E-mini futures primarily to analyze the market through the lens of market profile, and that's what we're looking at now. So what I wanted to point out to you was just a couple of things as we come into next week. These are the things that I teach every single day in my Peter's Pre-Market Perspective, which is a morning 9 a.m. Eastern before the market opens report, talking about all these nuances of market profile, giving you key levels and scenarios that you need for that particular trading day. In that report, I talk about the concept of carry forward very often. The concept of carry forward is very simply taking the information that you've gleaned from the profile, which is, by the way, market generated information. And this is very, very important. Remember, market generated information. I did a video on this just recently, if you recall. I think the title of the video was Market Generated Information versus Opinion, or something like that, right? And the point is that there is sentiment in the market, there is opinion, there is feel, people going with their gut, whatever, news, this and that, but that is not market-generated information. Market-generated information is information that is generated by the market through the simple movement of prices that leave marks in their wake on either traditional charts or on market profile charts. And because the market profile chart is broken out into multiple 30-minute periods showing us where price is traded in those 30 minutes, when it's all put together into distributions that look like this, it leaves us with an immense amount more of market-generated information than we would get from a traditional candlestick chart. There's really a lot of information to be gleaned, and that's why I discuss this concept of carry forward and the concept of narrative all the time. This is very, very important. You want to carry forward market-generated information that you gleaned from history into your daily trading, and as you continue to pull that market generated information from the profile chart day after day, you build an ongoing narrative so that you can use that information of potentially what happened yesterday, the day before, maybe a week ago. You're looking at all that and you're building a narrative, and that narrative hopefully is going to lead you to a better understanding of where price should go in the future, etc. Okay, basically. So let me just point out a few nuances that I'm seeing here in the profile. One of the things, and obviously you could technically see this like on a SPY chart, but I really like looking at it on the profile because the profile is showing us clearly the overnight action in the lowercase letters. These are the overnight activity, and the RTH activity, which stands for regular trading hours, is always denoted by the uppercase letters. And the first thing I wanted to point out is we now have two relatively large gaps. I should say relative, I mean they're huge. Two pretty big gaps here underneath us that remain unfilled. So we have this gap, which has never filled. This activity here happened in an overnight session and never counts towards the fill in market profile theory. Understand that overnight sessions, obviously they're, the overnight sessions are the ones that create gaps, so obviously they can't count towards filling the gaps. But once they create the gaps, if in subsequent subsessions an overnight distribution comes down into the gap, that gap is still considered unfilled. Those overnight that overnight activity does not fill the gap, so just keep that in mind. So we still have a very large unfilled gap there beneath us, and we have an even larger unfilled gap here. This was the 75 pointer when the ES gapped up 75 points and essentially held, and then just started chugging higher from there. So why am I talking about these gaps? The main thing to consider is that, yes, all gaps fill eventually, right? And sometimes it takes a long time, but for the most part, all gaps do fill. The market doesn't like gaps. That being said, when we know that the market generally doesn't like gaps and that they should fill, it's basically a pretty classic when what should happen doesn't, right? I call that hashtag WWSHD. Very simply, that the market is bullish, and when more and more gaps stack above, two things are happening. The market is getting somewhat dangerously overbought because it should come back in. It's just like when we talk about the virgin points of control, right? This is a concept I teach a lot. VPOC, virgin point of control, simply means those price levels in the market profile where the greatest amount of volume was traded in any given session, or time spent, depending on how you calculate your VPOCs. And yet the market never came back to that high volume area in a subsequent session, leaving that high volume node untouched, hence the name virgin point of control, or VPOC. So when the market is stacking up VPOCs below it and also stacking up gaps, like I said, it is a sign that it could be somewhat short-term overbought, but it is also a sign of immense bullishness. It is a sign that the market doesn't feel like going back to fill the gap. It doesn't care. It's not doing what it should, quote unquote, and it's just galloping forward. And I firmly believe that that is the narrative that you should follow. A lot of people get very burnt and hurt always thinking of the counter move or what should be happening, or, oh, there's a gap there, so I'm going to buy a bunch of puts in the gap because we're going to go in there, and then the puts go out worthless. You want to really be on the side of strength, or I should say, to be clear, on the side of momentum. And the momentum players right now are clearly leading the day, and they're obviously completely winning over any bears out there who feel like the market should be filling a gap or should be coming back down to a VPOC or whatever. So keep that in mind. You want to just, one of the hardest things to do in the market, but what is really the simple holy grail of the market, is very simply to just be able to discern what the direction is and have confidence to get in on that direction and hold it, right? It's really, at its core, trading is not much more complicated than that. But the problem is that I think a lot of people bring too many outside data points into their analysis that are not very scientific, meaning that they don't have anything that's really tied to actual price action. They're going on news or sentiment, or, you know, there's going to be another wave of COVID and blah, 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 and they're not using market-generated information. And like I said earlier, you know, market-generated information is always going to be far superior to opinion or non-market-generated information, all right? So anyway, first thing is gaps. Gaps remain unfilled. Continue to carry them forward. Next thing I want to point out is that this market has had a lot of spikes, and the spikes have been kind of negated, meaning that they never really led to lower price action, right? Which I think is interesting. We had a spike low here in N period, which I thought was interesting. And notice that when the spike low came down, a spike is basically just when you have a lot of single prints at the end of a day. When the spike low came down, this was just a couple of days ago, this was Thursday, where did it go? It went actually right to a prior high, which is noteworthy, but more importantly, not just that it was a high of a prior session, it was also the low of an upward spike. So you have a downward spike coming into support of the base of a spike. Now, why is that significant? Again, I think it's really simply significant because when you see this type of very precise action in play, it tells you that the market is trading with a lot of momentum. It usually means that a lot of shorter term traders are really just batting it around, and the longer term money is really just holding. They're not really getting involved in that. You have very, very short term momentum money that's pushing the market higher, and they're the ones that are buying at these very nuanced lows, such as prior highs, etc. Always like to keep that in mind. And then what's noteworthy is that on more news driven action, Friday, for a little while, was actually bearish in the sense that it took out that low. But notice what happened. There was really no follow through, in that we know we have gaps down here. We had also a virgin point of control here where there was a greatest amount of volume traded in this session that was never traded through in these subsequent sessions. And look where the market comes down. It comes down on news again. This was the Friday, as you know, was really wild. On May 29th, there was you had the executive order the night before of the move against the social media companies, and then the Hong Kong news, the China sanctions, but it ended up being kind of a nothing burger. They just wanted something with the WHO, etc. It's all literally enough to make your head spin. And like I always say, at the end of the day, you should be able to trade on an island with a laptop with an internet connection that only has a data feed and nothing else. I mean, especially if you're trading just on an overnight basis, I'm saying, right? If you're just analyzing the market on candles that close at the end of a day, you really don't even need to know that stuff. You kind of need to know that stuff if you're a day trader, because, for instance, if the president is speaking at 2 p.m., okay, so you probably don't want to be in a day time frame trade ahead of that, or that the next day, like we had this week, there was going to be some action against China that was going to be announced right on Friday afternoon. That was the press conference that was sometime Friday afternoon just before 3 o'clock. You would want to know these things from a day time frame perspective, but from a longer term perspective, you should be able to just come to the charts at night once everything is closed and see the marks that were left on the chart and see what market generated information you can glean from it, okay? So I'm carrying that forward as well. I'm also carrying forward into Monday. that we did not get a POC here that migrated up at all. So that means that Monday is also going to be spike rules. Spike, remember, you can find these definitions on our website if you scroll down to the footer. I also have them all hot linked in my Peter's Pre-Market Perspective, which is the market profile report that I write every morning that I was alluding to earlier. All of these terms are always hot linked there with tool tips, whereas you're reading it, all you have to do is mouse over. If you forget, what does he mean by spike? What does he mean by VPOC, et cetera, it's all there. So spike rules will be in play on Monday morning. I don't really think, in kind of analyzing it, that it's any major like spike that we have to like wonder if it's going to be accepted or not. And the fact that prices didn't, the point of control and the value didn't really migrate up with price, because obviously this was all on the late day news conference, press conference stuff going on from Washington. And the reason I'm not all that concerned about it is simply because we were higher in a prior RTH session. So a lot of this is just backing and filling coming up into here. So again, bottom line is, even though I would have liked to see this point of control migrate higher, but it couldn't in Friday's session because of the spike, everything happened late day. Monday, your number one MO is simply going to be to mark off the level of spike and see where acceptance is. If the market trades anywhere in here, that is acceptance of those higher prices, because now time, which is measured by price and or value rather, which is measured by price plus time, is going to basically be confirming those late day traders who bought it up to there, basically. So that's what we're going to be looking for there in the profile on Monday. All right, last but not least, let's just take a quick tour through FANG and gold and crude, because there's some trade ideas here. As I alluded to earlier in the video, I like what the NDX is doing with those multiple tops, and I believe the NDX is higher next week. So I wanted to just kind of focus on these stocks very quickly, because there's probably going to be opportunity in them for next week. All right, Facebook now has two trend lines going. It's got this one off of the lows, and then that's a primary, and it has a secondary here, which is steeper. That's a bullish sign, just tells you that the advance is steepening, getting more and more momentum to it. Facebook has already made a new all-time high here in the 240 level. I think that Facebook needs a little bit of time to chill out. I'm looking at this area here where the market could come down into to potentially be short some puts, maybe against this trend line. A little bit more down action would be better though, like maybe breaking the trend line and coming down here, but that may not happen because we do have this 20-period moving average that is rising right up beneath it. So obviously Facebook very, very bullish, but I don't think it's really at a buy point just yet. Netflix, this one's kind of tricky. I do have a long spread on in it. I'm actually in a condor that is $10 wide, and I actually own that now for like 70 cents. Again, this is a live trade from Weekly Options Advisory. We are in the 420, 430, and then also short the vertical 445, 455. So that's called a condor, where you're short one vertical here and long one vertical here, and obviously anywhere up to here, the maximum value is $10, and because of some cool broken wing butterfly put selling against the 390 level, we were able to get our cost down to about 70 cents currently. So that's going to be a sweet deal if we can rally. But I will say, in the bigger picture, if you are not in Facebook just yet, Facebook is a little bit confusing here in that it's got support here clearly in that 390 area, but it hasn't really done much, and this move was really a big shakeout coming down pretty hard. But I've come to expect this from Facebook. That's kind of, or not from Netflix, excuse me, that's kind of how it trades. All right, that's Netflix. Let's talk about Apple. Apple is very solid. Apple, I believe, wants to retest the 327. That's pretty obvious. You have a balance area here, and I think we're going there. This actually, on a bullish market, could break out higher. I wouldn't be surprised if the NDX went to the target and Apple actually used that same move to break out higher. We shall see, but it is quite bullish whenever you have a balance area like this, and then what happens is the market is balancing in the same area but slightly lower. And this is actually a very, very important thing to mention, because it works really well in day trading but also in longer term trading. The point is this: you do not want to short this high here. And I'll tell you why. Because the point is that when the market is consolidating like this just underneath a key level, okay? The way you want to treat that is the fact that this action in the consolidation where you keep going up, pulling back, up, pulling back, up, pulling back, guess what? That is the pullback, right? Because think about it. If you break out of here, don't you think you're going to have enough momentum to shoot right through here? You see what I'm saying? So you don't want to be initiating any shorts really against this level, because the potential is you're going to break through it because you have this large area of balance already happening just below it. So keep that in mind. That's a very good tip, trick, whatever you want to call it, that you can use in all time frames. If I see a stock on a day trade that's coming up to a trend line and it comes to within like 50 cents shy of the trend line and then backs off, I cancel my order that I had short at the trend line, and I'm not going to try to short the trend line when it decides to retest it. That was it, basically. The pullback against the line was that movement that was 50 cents away. Sometimes technical levels get hit exactly, and sometimes technical levels come close and fall away, and then the next move breaks through the technical level. So keep that very much in mind as you're looking at Apple this coming week. All right, Facebook, Apple, Netflix. Let's look at Google. Also kind of messy, just a slow grind upwards, but I do think this is the target. That's obvious. And this is actually pretty cool because you've got a decent amount of distance here to go for it. So this may be a nice opportunity to put on some sort of broken wing butterfly or 1/3 ratio or something that's using the credit that can be sold against the 1530 level, and maybe some long options down in here, and capturing some of that movement up for a relatively low price. All right, FANG, as we know, is now FANGMAN, so that means that Microsoft is one we have to discuss. I've been watching this for a while. I don't have a trade in it as of yet at all, but I think people need to realize that if this market holds up, and by all intents and purposes it should be holding up longer given what the Fed is doing, etc., and moving more towards the country reopening, etc. The market seems to like that sort of thing. This is probably going to 200. That is the next key level. So I haven't done anything yet, but I'm seriously thinking of setting up something on a slightly longer term where I'm going to be targeting that 200. Probably, if I know myself, I know the way I like to operate, I don't like to pay a lot for options. I'm probably going to get into some sort of a longer term vertical and then just spend every week selling against that vertical and whittle that debit down lower. I'm in the exact same trade in gold right now that I've had on for weeks. Now I've got my spreads down to like 50 cents cost. The spreads are worth $4, and today I started harvesting them for like a couple bucks a piece as gold was moving up, right? So that's the thing. So you have a spread, you sell against it little by little. You take a long expiry and you sell shorter expiries against it and try to get that cost down. And again, remember, the point of that always is if the situation fails or takes longer than you think to get where you want it to go, you will lose less money or no money, and that is a beautiful thing. All right, Microsoft, and last but not least is NVIDIA, because again, it's FANGMAN now. I hope I got them all right. Facebook, Apple, Amazon, Netflix, Google, Microsoft, yes, NVIDIA. NVIDIA is last but certainly not least. I would not probably be doing anything in NVIDIA this coming week. It is obviously stronger than the market, or stronger than the NDX. It broke out and then went higher, had a pretty nasty pullback, but look to where. That probably, obviously in hindsight, that was a buy point. Why? Because it was the prior high, but now you're just kind of very much more or less in the middle of this range, maybe a little bit higher. So I think the video would kind of be chasing it a little bit if you were to be looking at a trade in it now. All right. As I said earlier, I want to just mention two quick things on crude oil and gold. Crude oil, obviously, you've had this big run off the lows. I know that I said a number of times this was going to be the trade of the year, and it was. I didn't actually do it, and one of the reasons was simply because Thinkorswim all of a sudden stopped allowing traders to enter new positions in gold, in crude futures contracts. In all this madness coming down here, which is really when you would have wanted to do it, right? Thinkorswim decided that they didn't want people trading, buying crude contracts. So that was, kind of a disappointment. But in the longer term picture, I just wanted to point out there's a gap here that needs to be filled. And this pattern also is very bullish. And I think that, to me, the pattern kind of spells more of a risk on for equities, really, right? It's a confidence thing to me. The price of oil, you know, it goes in phases where it's correlated, where it's not correlated. And I think right now it's correlated with stocks in that they're both a sign of optimism of, you know, whether people are bullish or bearish on the economy, etc. You can see we're all the way back up to 35 a barrel now. That gap fill is probably imminent. As we know, as I always say, gaps are voids of price action. Nothing happens in, you know, there's no resistance in the gap, so more than likely crude wants to see 40, and I think that's bullish for stocks. And last but not least, gold is looking like it wants to finally resolve this long consolidation, although gold is somewhat of a heartbreaker. That's why I always say if you're going to trade gold in the relatively short term, you should probably be buying some call verticals and selling shorter term expiry call verticals against them to whittle down that debit, as I was saying in the trade that we have on right now, because gold is the heartbreaker. It will just rip up and then rip back down, and you think you're doing great, and you know that's just how it is when you're short-term trading it. When you're long-term trading it with physical asset, the physical asset, or leaps, which I have both. I am long a lot of physical gold, and I'm also long leaps that have, you know, multi-year call contracts. I don't watch these sort of things. I could care less. Gold is down $80 in a day. I don't even blink. But when you're in call contracts, for instance, that expire a month from now and you paid $3 or whatever, then you got to be a little bit creative and, you know, see where you know, try and get that debit down as low as possible. That being said, let's watch this week to see if there is going to be this breakout from this area. Obviously, if we put it out on the weekly, it shows you the consolidation is even more bullish. Notice the higher highs, and then going out to the monthly, boom, we are still on track, as I've been saying, to eventually retest the prior all-time highs.